Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello everyone, Chad Frantzen here with the Kingdom Finance Show. Thanks so much for joining me today. In our last couple episodes, we have talked about the economic outlook for the U.S. and globally for 2023. And on today's episode, I want to take those concepts and provide some application in a teaching manner. Again, this is going to be our opinions on how to invest. And so I want to talk at a high level of based on where the economy is, where do we believe are good asset classes to invest in? So let's get started on that a little bit here as we talk about the rising dividend strategy. The rising dividend strategy is really a concept that many investors have used for decades. In fact, many of the great value investors always look at one thing as defining an asset as this. An asset is something that puts money in your pocket. And so much like the concept of if you own a house and you rent it out and a person pays rent, net of your expenses and mortgage and any other things, you've got net cash flow coming into your pocket. So if we're going to learn to be wise investors, if we invest money into an asset or an opportunity that someone presents us, we want to know how is that money going to be returned to me? So when am I going to receive cash flow distributions from that? So we're really big believers at WealthBuilders. We want to know up front what types of asset classes are going to be most resilient, whether the economy is flourishing or whether the economy is in a state of chaos. Now, I want to talk a little bit here. We'll probably do a whole separate show on this, but one of Billy Epperhart's teachings that is a fan favorite, it's one of the first ones I ever heard him teach on when I met him, was what's called the triple X concept. And many of you know that the triple X concept is how do we understand how to receive cash flow, dividends, interest, and the like in a passive form. Now, we talk a lot about in our workshops, earned income, ordinary income, and then investment income. So the triple X concept, which is found in Billy's book, Money Mastery, and we talk a lot about at our workshops, is really this concept that there are 6 general categories by which to generate passive streams of income. So let's just run through them at a high level, and then I would like to apply that to a strategy on how to invest. Does that sound good? All right, let's get started. So the first one is real estate, as I've already mentioned. Very conceptually easy to understand. All of us have probably at one time or another rented a apartment or a condo or a house, whether we were in college or right out of college or maybe in transition or building a house. And so that concept applies where you own a piece of property and you are renting it out. And whether you have it professionally managed or you self-manage yourself, then you have some form of what we call mailbox money. And that's most often today direct deposited to your checking account each month. So rental income, whether that's residential or commercial, that is category number 1. Category number 2 is distributions from business ownership. Now, many of us are small business owners and entrepreneurs, and some of you work at times, 50, 60, 70, 80 hours a week on that. This category for passive income is designed around distributions from a business that you are not having to work, 40 hours a week in. So in essence, you are owning the business, you're keeping tabs on what's happening, you have a pulse on what's happening, but you don't have to be, shall we say, in the kitchen cooking to make things work day to day. So business owner distributions, number 2. And in fact, in my personal career, I would say these first 2 are where the majority of wealthy individuals and families, where their wealth is created, whether they created it themselves or if it was inherited or passed down from preceding generations. Now, the next 2 categories, again, we're talking about the triple X as a concept. And then as I explain these 6, then I'm going to talk more about what we call the rising dividend strategy and how you can design a similar type portfolio. The next 2 categories are very synonymous with the stock market. And so the next 2 categories are what we call dividends from equities or securities. These most often are going to be public or private companies. They might be a mutual fund, a ETF, could be an individual company that pays a dividend. But dividends, traditionally in the United States, those are paid out quarterly, and the investor can choose to take them as cash or reinvest them. So dividends from equities is how we're going to call category 3. Category 4 is fixed income interest or interest from a coupon. So many of us are familiar with investing in a CD at a bank or perhaps a U.S. government bond or maybe a bond fund, things of that nature. So interest payments from a debt instrument. Dividends come from equities, and interest coupons come from some form of loan or debt instrument on that. Again, government bonds, CDs are probably the most popular ones in the United States. These types of cash flows, they vary from low interest to high interest. Some of these pay monthly, some quarterly. Some, in the case of a CD, may not even pay interest until they mature, perhaps after 6 months or 12 months. But nevertheless, we're talking about streams of passive income, and that would be category number 4. The last 2 are forms of what we call royalties. And so number 5 is royalties from intellectual capital. So many of you listening have either personally or you know people who have created intellectual capital and actually monetized it. So the most common method for that you see in the public eye is going to be things like writing and publishing a book, writing and licensing a song, something of that nature. Again, there's a lot of different things that you can create intellectual capital on, whether it's a trademark, a licensing agreement for concepts. And we see that in the financial markets, the manufacturing markets, and really every industry on that. So intellectual capital, you in effect license or brand your ideas, and then those that use it pay you some type of a licensing fee or a royalty for that. Much like when music is played or books are sold at the airport, there's a small royalty that's paid to the person that originated that concept or content. Number 6, royalties, another type of royalties. Number 6 is royalties from hard assets. So the previous one, royalties from intellectual capital, it's more of a soft asset, right? It's intangible, if you will, ideas, concepts, songs, and books, somewhat of an intangible soft asset, but certainly really great ways to bring value to the marketplace for what they are and also to create recurring streams of revenue. Now, number 6, the hard assets, these are going to be, as the name implies, a tangible asset. And it, like the other form of royalty, creates some type of cash flow off of it. Now, in my experience, the most common royalties from hard assets are going to be some of the traditional things you would think of from America, oil and gas, ranching, and even now in the modern day conservation. Oil and gas, I'm from Texas, so that's a big business, oil and gas and ranching. Those are tangible, hard assets, right? Farmland. You're actually getting cash flow off of those things as those tangible assets are producing a harvest on that. So That is a summary when we talk about the Triple X teaching. And again, we'll teach that on a separate episode. But I'm going somewhere because I wanted to introduce the Triple X and these 6 streams of passive income. Because if you're like me, I want to have an understanding on how I can become independent of having to work a 9-to-5 job. I still want to bring value to the market in my job, but I also want to learn how to be a good steward to invest in things that will create recurring cash flow. Now, a lot of viewers will ask us, well, okay, we read Billy's book, Money Mastery, or we came to a Wealth Builders conference. So how do I take these concepts and do I need to do all 6 of them? Or how do I get started? This seems a little overwhelming. I might be dabbling in 1 or 2 of these. Most wealthy individuals, from our observation, they gain a level of mastery over 1 or 2 of these categories. So I want to encourage you, you do not have to become a master, get 10,000 hours in each of these categories. Most studies show, and I've talked with Billy Epperhart about this as well, that if you can really gain mastery over 2 of these, then you're well on your way to becoming very successful and making a huge impact on your community and for the kingdom of God through your giving. Now, we came up with this concept of, well, let's create a rising dividend strategy. Right? We understand these concepts. How can we put some of them together into a portfolio, shall we say, to where it's a little bit easier to get into these categories of investing? Well, let me talk a little bit about the stock market components in here, dividends and interest. Again, when we look at public companies, we're looking for companies that for one, follow biblically responsible ethics and what we call pro values. We want to invest in companies that are not attacking Christian ethics. But we also want to look for companies that are well run. We want strong business models, a proven track record, and really a commitment to returning shareholder equity through dividends. Right? So in the stock market, we call this value investing, if you will. So value investing is saying, hey, I want to understand what the company's doing, what product or service they're offering, and I want them to be really good physically and really good with how they treat their employees, how they're committed to their community, and also their commitment to pay dividends back to the shareholders. So there are several dozen companies in the U.S. and globally that have a track record, 10, 20 plus years of continually paying dividends back to the shareholders and increasing those dividends each year. Now, we're in a period right now of rising inflation. And so that's really important to know, hey, how do I keep up with inflation? Well, let's invest in dividend paying instruments that increase how much they pay each year. Again, there's a lot of ways to do this in the stock market as far as individual stocks. In the bond market, we have individual bonds, and you also have mutual funds and ETFs. Again, we're not giving specific recommendation or specific solicitation of funds on this show, but you want to be mindful when you're doing your research on these of A, do they have a pro values focus or not? And then B, what type of, if it's a fund, what type of internal expenses are you paying that may or may not affect what we call your dividend rate? For these, we're really looking for things that can be resilient, whether the economy is bullish or bearish. And that what I love about creating a rising dividend strategy is, you can create a report at the beginning of the year, look at your portfolio, and you can see, regardless of who's in public office, whether it's Democrat or Republican controlled Congress, whether the economy is growing or neutral, how much cash flow you're generating from these different categories. One of the things that we did in this rising dividend strategy, so again, let's revisit. We talked about those 6 categories at the beginning, right? So we talked about rent from real estate, business owner distributions, dividends from equities, interest from debt instruments, and then two forms of royalties, right? We had the intangible and the tangible asset classes. What we've done with our Wealth Builders portfolios is we've created a way that for families that we work with, and again, we have to sit down with them and evaluate their suitability and their long-term goals, but we have created what's called a rising dividend strategy where we've actually incorporated 5 of the 6 categories in the XXX teaching. So the 6th one, the one we don't have in our portfolio, is the one that relates to intellectual capital. However, as many of you may know, Wealth Builders has several different coaching programs, and we got some amazing men and women that lead these coaching programs. We have a real estate coaching program, and we also have a business coaching program. And within the business coaching program at Wealth Builders, that team can work with people to educate them, create a defined plan on how to monetize their ideas and how to create intellectual capital. So we have that one covered in the Wealth Builders family, and that is through one of our coaching programs. Let me dive into a little bit here with the last few minutes here on this episode about the portfolio. So we're going to take the 5 categories, everything but royalties from intellectual capital, and we're going to create a balanced mix of rent from real estate, distributions from investing in businesses, dividends from equities, interest from bonds, and royalties from hard assets, right? So if you think about those 5 categories, you create a balanced mix of those 5, and now you have what we call the Wealth Builders Rising Dividend Portfolio. Now, the merits of it are, to summarize, is 1, we want to be very diversified when we talk about managing wealth and making an impact. So within these 5 categories, we have this concept called correlation. So one of the things I want you to understand is you want to have certain investments that are not correlated to other investments in your portfolio. If everything is correlated, then if the economy is going great or the economy is going terrible or a Democrat's in office or Republicans are in office, those investments are they're going to operate very similarly. So you're not going to have true diversification in that. What I like about the rising dividend strategy is we take 5 very diverse ways to create passive cash flow, right? I think we would all agree that those 5 are very different from each other. We're not just going to put all our money in the stock market and go about our business and hope everything's okay. We don't necessarily want to take a buy and hold, buy and hope approach to investing. We really want to have a systematic way to monitor how the investments are doing, right? We want to see cash flow, right? Cash flow is the definition of an asset. It puts money in your pocket. Now, a lot of people will get fear of missing out on the next great investment, and you want to go put some money in crypto or some new technology stock or some energy, green energy stock, and that's what we call speculation. That's not actually the definition of investing. Investing is understanding an asset, having a perspective on how to monitor it, and the asset having what we call tangible value or book value, if you will, on that. So big difference between investing and speculating, right? And then, of course, you've got gambling way over there. But speculation is not gambling, but it's also not long-term investing either. So the rising dividend strategy is very much a values approach. Again, we want to screen our investments to where we understand the people behind the companies we're investing in, that they align with our values, and that they have a proven track record to return cash flow to investors on that. So again, that's what we call the rising dividend strategy. And I hope that's been helpful. Again, if you have specific questions on this, happy to visit with you all offline. You can connect with us, wealthbuilders.net/invest, and happy to chat with you. But again, I think if you take these principles of the XXX, understanding how money is created, understanding that to be a wise financial investor, you want to have a plan that is really storm-proof when you think about, well, gosh, do I need to change my portfolio? Well, if you have a mix of real estate, of hard asset royalties, of fixed income, of dividend-paying securities, of private business distributions, and you're going to have really a pretty good plan for being storm-proof. Now, it doesn't mean that you won't see times of volatility in your investments, but I think I speak for a lot of us at Wealth Builders is if we can have a clear understanding of what our money is doing, how it's working for us, and how it's returning capital, then we're on a pretty good start to navigating the economy, whether it's the economy of 2022 or what we feel like we'll see in 2023 and 24. Hey, I hope that was helpful. Thanks so much for being a part of the Kingdom Finance Show. Again, this is Chad Frantzen, and we look forward to seeing you next time. Again, for more information, wealthbuilders.net/invest. Take care. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show.